so without the unemployment numbers going up, we're having a strong consumer, which is 2/3 of our economy. A strong consumer is keeping this economy going, although it has slowed, but not nearly to the extent that everyone expected.
Joe, you want to touch on it feels like things are going in a positive direction as it pertains to interest rates in the last couple of days. Any thoughts on that?
Yeah, 2022 was a huge decline in all asset classes, fixed income, stocks, bonds, and everything but energy, went down. And so all of that was pricing in what the expectation was in 2023. In 2023, the expectation we would have a recession. Well, it didn't show up. And what happens when most times when the Federal Reserve raises rates to kind of pump the brakes on the economy, you end up getting a slowdown in earnings. What happens when you get a slowdown in earnings? Corporations let go of their employees to a certain extent. You have more unemployment. As unemployment rises, spending slows down because less people have money to spend, and people are worried about losing their jobs. When you have slowdown in earnings, and then you have slowdown in spending, you get another slowdown in earnings, and you get another layoff. So it's kind of a nasty process where earnings go down, layoffs happen, earnings go down, layoffs happen until it bottoms out. Well, 2023, we didn't have any real serious layoffs. In fact, unemployment is near a 50-year low. And so without the unemployment numbers going up, we're having a strong consumer, which is 2/3 of our economy. A strong consumer is keeping this economy going, although it has slowed, but not nearly to the extent that everyone expected. So the S&P 500, for example, which you could see as a barometer of the economy, is only back to where it peaked out in the end of 21. So it's a 2-year goal, 2-year peak to trough to peak that we've seen. So everyone's like, wow, this market's gone up too much. Well, it's 2 years of coming back to where it was at the top of 21. And so going forward next year, which I don't think anyone can really truly guess where the markets will be, but I think you can have a higher probability in recognizing that unemployment is going to stay relatively low, consumers going to stay relatively strong, so the economy is going to continue to be really strong. You add on top of that the artificial intelligence. This is a dot-com-like transformation. This is printing press, industrial revolution, automobile. This is one of those innovations that's going to change everything in ways we can't even imagine. And so that kind of innovation is going to have some huge economic benefits. And it's hard to fathom. But we are going to continue seeing efficiencies in all industries. Artificial intelligence can help the hospital, the tech company, the airline industry. Every industry can be improved with this type of technology. So more innovation, more prosperity, more growth. And so what's likely to happen with interest rates, which is your original question, is we're going to see what we've peaked out on. You think about mortgage rates, right? 30-year mortgage rate peaked out at like something like close to 7.5. It's all the way back down to sub 7. We're seeing that kind of continue to fall because the market is anticipating that the Federal Reserve is going to lower rates. Well, why would they lower rates? Well, because as they raise rates, it slows the economy down. There'll probably be a point where that's not needed anymore because inflation will hit that 2-point level. And what I think is fascinating is that on average, 7 months after they stop raising rates, which was about 2 months ago, on average, it takes 7 months before they start lowering rates.